Well, good morning to all attendees of the Paris Your Place Forum. It's time to tackle what might be the biggest issues markets and portfolio have been struggling with so far this year. Words: instability. Geopolitical tensions, energy issues, inflations, volatility, COVID rates hiking. We could go on for a while with the list of all events happening all at once that characterize our current unstable macro environment. But what's important is what's going on the field. And if the big picture might look a tad worrying, there are still reasons to remain optimists. And in order to figure out how much optimist we should be, and how does that environment play out in private markets, especially in the tech sector, I'm very much delighted to welcome 4 experts on stage this morning. And starting with Virginie Morgon, Chief Executive Officer of Alternative Investment Manager Eurazeo. And we have Pierre DeMonsant, Chief Executive Officer of Strategic Portfolio Management Company Planisware. We've got Pierre-Henri CHAPPAZ, Co-Head of European Technology of Rothschild and Company. And we still have also Bruno BEZARD, Managing Partner of private equity firm Cathay Capital. Thank you for joining us this morning. Let me start that session with Virginie. Virginie, all private asset classes have reacted in different ways to the current unstable macro environment and to that market paradigm shift that we saw starting. My question there would be, how's that impacting your portfolios and fundraising?
Thank you very much. Good morning, everyone. Thanks for having me. Just before I jump into trying to answer your question, which is the question of the moment, just sharing some optimism in that gloomy environment, of course. You know, we're not blind. I was at Choose France yesterday. Many international investors coming with great interest for France. And the sharing of our optimism would probably be about the awakening and the wake-up call that both crises, first COVID and then Ukraine invasion, have made possible in a way. First, you know, healthcare autonomy, relocalization, reindustrialization in Europe, acceleration of digital adoption, disruption. I think we all agree here we've probably gained 5 or 7 years in early adoption of digital habits during the COVID, which is a massive positive on many fronts, including climate. And finally, following, you know, Ukrainian invasion by Russia, this awakening of we have to do something about autonomy and acceleration of what Europe was already championing in renewables investment in Europe across the board. So there was, of course, concern, and I'll jump into your question about inflation and what impact on portfolio of an investment company like Eurazeo. But it's always important when we are worried in a very volatile, uncertain, and extremely complex environment to also remind ourselves that there's always good out of crisis. And of course, might sound a little bit cynical, but there'll be a lot of investment opportunities. It's always been the case in crisis situation. But just sharing that optimism, which, you know, we could sense yesterday with so many of foreign investors and CEO and leaders at that event yesterday. And climate and digital are very much at the, you know, forefront of that optimism, especially with the leadership of France and other European countries. So let's keep up with that great momentum that we've created for the last 5 years, I would say. So to your question, I mean, how is the portfolio reacting? I mean, any alternative asset manager would say that we are building portfolio with always risk at the very core of our mind. So never get a too big exposure to neither a sector or a company. So normally, a portfolio of a private equity player should be future-proof, because that's how it's built. Some companies have more leverage, some companies have absolutely no leverage. Every investment that we have at Eurazeo in venture and growth have no leverage, so you have no exposure to interest rates, you know, growing. And where we have interest rate, because we have leverage in the buyout activity, where we cover our interest. Usually 70–80% of our debt is being covered right from the start, putting in place financial coverage. So the diversification is absolutely key when we build a portfolio. That would be one first comment. Second, I mean, there are some asset classes which actually love inflation. The thing is not, it's about how fast. And I don't think anyone knows in this room, and if someone knows, please share, your vision, because we don't know how fast interest rates will rise. And that's the worry. It's the worry for insurance companies, it's the difficulty for banks, it's a nightmare for investors. If interest rates start to rise very fast and very steep, that will be a big concern.
But in that context, what type of investment would you look at, for
real estate
in order to keep pace?
is always a good investment when inflation comes back. If inflation comes back not too steeply. So it's about the curve, and that's where I don't think we have all the answers. Also, although, BNP or JP Morgan or some of the very large banks have a view, and of course have economists telling us where they think inflation and interest rate will go. The complexity will be the decoupling. We've been facing decoupling over the last 3 years on all levels, geographical decoupling, sectors decoupling, within sectors that we thought, used to change in terms of momentum the same way across, GDP, and that has completely changed following COVID. I like, as an investor, I like asset light. This is what we do a lot at Eurazeo when you invest in tech and growth. When you invest in software, in business services, you're probably more asset light than some other investors or industry. And being more asset light, you're better protected. Because if you're asset heavy, many investments in terms of CAPEX, in your production, plants, you're more exposed in terms of your supply chain, raw materials, supply costs. So industrial players, for sure, short term will be more exposed and more impacted. I think that may help in the discussion we might lead on that panel. And I think also you could mention some sectors which, as I said, would be very much supported by inflation if the curve is progressive in terms of interest rate rebalancing.
Thank you, Virginie. Let's talk about tech. Pierre-Henri, unstable is meaning also more risks for both companies and investors. How does that shift in risk materialize and affect companies in investors' behavior in the private tech sector?
Yes, if I take a step back, between 2017 and 2021, we used to live in a world which was quite unknown and quite unique in the history of capitalism. Negative interest rates, low inflation rate, excess liquidity, encouraged by central bank policies facing COVID crisis. And so in these circumstances, as a result, cost of capital was free. And in such world, the best performing companies were capital consuming. And it also explained the large growth equity investments in companies toward growth, revenue growth, despite all of our criteria. And on one hand, it was a very good thing because this massive capital injection in the tech space generated an unprecedented innovation wave. On the other hand, it is also fair to say that these circumstances are encouraging maybe, speculation behavior. No, what is happening in 2022, capital is expensive again. Due to new risk perception, uncertainties around interest rates, are they high enough to put inflation under control? Uncertainties around military conflicts, what will be the impact on the war in Ukraine, both on a political and economical standpoint? It is very difficult to quantify. And also, I would say, uncertainties around weaknesses of our old economies. For example, level of public debt, but also infrastructure weaknesses, such as hospital, military defense, but also power generation, as illustrated in the last conference. So yes, as a result, risk is back and cost of capital is high. And guess what? The worst performing company as of today are companies, are cash-consuming companies in this new environment. But when I say new environment, I may be wrong, because I think that, and I will come back to that later, maybe we are just going to a normal situation. But it is fair to say that as of today, we're experiencing a peak in uncertainty and in volatility. And it is well known that volatility increases the price of optionality. So in order to protect their returns, investors are not looking at optionality anymore. They are looking at de-risked business model. And what is de-risk in tech is very difficult to assess. But as of today, both the private market and the public market are trying to simplify the answer by profit visibility.
But like in any environment, there will be winners and losers, I guess. And which models in the tech sectors are most likely to survive and to thrive post-unstable environment?
Well, I think few years ago it was very difficult to talk about profit. You know, it was not the key buzzword, as we all know. As of today, it seems profit is going back again. So I fully share the assessment of Virginie. I think that profitable software companies in all sectors will be one of the winners. Unprofitable leaders established in fast-growing markets without immediate liquidity risk will also be the winners. And we can also look at specific sectors such as entertainment, for example, gaming, digital media, etc., which are now valued at, one can say, a very decent entry point.
Okay. Bruno, what do you stress in terms of flows and opportunities for your funds in that current environment? Are you struggling with your funds today? Or?
Actually, to be frank, there is absolutely, we don't see any decline in deal flow in Cathay. Lot of opportunities in venture capital and also in private equity. I think one of the reasons is that we invest in 3 continents, and we are deeply rooted in each of these markets. That makes sense, and that brings a very steady and interesting deal flow. Basically, what we have seen during the COVID situation is that when one continent was frozen, the 2 other continents were booming, you know. And I think this is a smart way to invest our LPs' money. Yes, and I think we love talking about geopolitics in France. Geopolitics is basically important, of course, but sometimes the real life is outside geopolitics. When you have in mind the negative buzz about China, and there are many reasons for this negative buzz. We will come back maybe later about China, I guess, in this discussion. There is a very strong negative buzz, but 2 remarks. When you ask global fund managers, the world leading global fund managers, 65% of the global fund managers are increasing their exposure. And they are right. They are right. It would be totally foolish if you run, you know, insurance life company or pension fund. You have a global ALM, asset liability management duty. It will be totally foolish not to be exposed to China, obviously. Second remark about FDI, foreign direct investment, which is also a way to measure the level of trust into an economy. China has never had as many FDI as last year, $180 billion, which is a 20% increase from the year before. So there is geopolitical talks, which are very interesting. We need to be in that. But sometimes the real life is in microeconomy. And maybe one last point about interest rate. Yes, interest rates, of course, are increasing. Let me just say that they are increasing, but they're still low. They are increasing. Is that a threat for us? Well, as Virginie said, and I totally share this view, we invest to create value into companies, not to play with leverage. The way we create value in Cathay is pushing companies to scale, growing the top line. So if you don't create value through leverage, or not very significantly, the reasonable increase of interest rate is not a threat.
So, as you said, China is opening ever more towards foreign investors, but at the same time, we see those tensions. And what I would like to know is, about those concrete changes that you see in the regulatory, in terms of regulatory perspectives in China. What concrete changes do you see?
Well, I think obviously we have to talk about the short term and medium term about China. Short-term situation is messy. That's the best word I can find. The COVID situation is what it is. One more lockdown this morning because 2 people contaminated in the south of Guangzhou. Okay, COVID situation is what it is, and even though it's far from being a democracy, there are some political agenda in October which freezes the country. So I think the current situation is not good. But don't be mistaken, it's going to start again. And China is a huge powerhouse which will carry on surprising us. This is for sure. In Cathay, we see every day a lot of new generation Chinese entrepreneurs, and they would surprise you. They are hungry, they have the drive, they want to grow. And when you visit their factory, at the end of the visit, they invite you for tea, or something more strong than tea sometimes. And they tell you which hour they're going to be listed with which multiple. And usually it's under the statue of Mao Zedong, of course. This is called Chinese socialism, okay? So in China, there have been some reforms, which sometimes have been misunderstood in the West. Some of them are about introducing new regulations it was called the Far East sometimes in China. New regulations about, I'm sure many people are aware of shadow finance in this room. G20 countries, and in my previous responsibilities I've been involved, have been telling China to fight against shadow finance for years. They did nothing for years. And now they are starting to say, for example, to Alibaba financial conglomerate, well, you have to, respect prudential rules, regulations that all the banks and all the insurance companies in this room have to respect. I know how difficult they are sometimes. So fighting against shadow finance is a new tendency in China, which is new and which I think is positive. Another thing, there was no antitrust policy in China for years. No, nothing. So the GAFA, which are called BATX in China, had strong power, very strong power. What they are doing now is they passed a new law, antitrust law. I read it. It's the same, nearly the same as the European directive or the French regulation, antitrust, and they're imposing fines on main players who do not respect antitrust policy. This is something that's probably they did not communicate well. That happens in China for many reasons, but which is positive. They have made many mistakes as well, so it's more or less balanced. But I think I'm always surprised to see big headlines saying that China is implementing some kind of clampdown on the private sector, going back to cultural revolution and so on. This is all bullshit. There are some policies, you may like them, you may dislike them, but private sector in China is and will be the leader, the leading force for the next 5 or 10 years.
Virginie, you'd like to react?
I just wanted to, before Pierre jumps in, I just wanted to react to Bruno's earlier comment. Your question, how do you invest in an unstable environment where you diversify geographically? Like if you're a global player, you're not dependent on one continent. I think for anyone in the room running any type of business, this is very much helping in preserving, many engines of growth as a company, as an asset manager, as an entrepreneur, where you can choose, you can be super selective because you see a very large market. And to my point earlier, being diversified in terms of sectors or profile of companies that you're investing behind also helps you weather whatever we have ahead of us but with strengths and some form of serenity. And to the point of China and the geopolitical, whatever happens, I so agree with Bruno that there's not much that we can do probably in this room about what's happening and what we have been seeing over the last 3-4 years between the US and Europe, and then Europe and China. But we're all, I would think, and I am, a deep believer of continuing to build for our European companies, our French companies, bridges. And I see Jean Lemierre on the second row there. We, Eurazeo, with BNP and CIC, China Investment Corporation, we certainly have a strategic partnership agreement in order just to help French and European companies to be better at what they do in China with local help from China Investment Corporation. And I don't think we should burn our ships just because of what's happening like now between Europe and China, because for the long term, I couldn't agree more with Bruno. Thanks.
Thank you, Virginie. Pierre, how does the current environment affect private tech companies in your view?
Yeah, good morning. That's clear that the tech environment is a little bit impacted. I think we have been seeing in the last year, the winner takes all model in the tech. Looking at the example of the Google, Facebook, and all these players, selling the idea of hyper growth, call that growth on steroid. So I mean, you burn a lot of cash and you promise to make some profit after 10 years. These models are severely impacted today. They still exist. I mean, you may still find company where this model will fit, but if it fails, looking at inflation, you already have the value because you discount the future value with inflation. But that's not only model in the tech model, and you have a lot of company in the tech model who are operating in a market segment, maybe smaller, who have a very strong position, very efficient business model, especially in the software. And if you look at Europe, you have more company of this type than the American model of winner takes all. So for this company, I think they can, if they're not profitable, they can generate profit in the short term, or they're already in the verge of being profitable, or they're already very profitable, depending on where you are. And I think it's reassuring for the investors. So I think they will not be so impacted. They'll be able to get some fundings. I'm sure you are already still funding this kind of company today. So, I mean, it's a mixed, and we can be impressed by what we see in North America, but a lot of people are dreaming of this, a lot of companies with this winner-takes-all model having a monopoly on the market.
And so how does that affect project management also, project portfolio management, sorry?
Yeah, so that's the area we operate. We help our customer to manage projects. And on our side, we see a big trend. I think such things have been said today. First, there is 3 major trends. The first is, our world is really transforming very fast. A lot of challenge, energy war, and so on. The first trend is digitalization. And I think we just scratched the surface of what we can do with digitalization today. There is a lot of things to do, a lot of new applications to do, a lot of productivity tools to do. So we will see a lot of things in digitalization still today. The second thing is energy transition. Energy transition is a huge, and we see Catherine McGregor with the objective of 2045 being carbon neutral. It's huge. We have to find a new way to produce energy, to distribute it. So new transportation facilities. So this is also a lot of things that have to be done. And the last thing is on the innovation globally, on the product. We see a lot of companies working on a more durable product, more sustainable product. They completely change the way they look at the product. It could be, the obvious example is automotive with an electric car, but you have a lot of companies who are trying to see how they can reuse or reconfigure products and to make them cleaner. Not talking only about the healthcare, healthcare product. There is still a lot of innovation. So when you look at all these trends and what's happening, it's what I call a project economy. It's a world of project. There is about 90 million of people working on project today, and it's growing steadily. And I think the good news for investors is that there is plenty of opportunity to invest in a useful and great project in the future. You know.
But I guess there is also bad news, which is maybe wage inflation for the tech sector, isn't it?
Inflation. Yeah, it's true. Everybody is talking about inflation. I think it has been a concern before today in the tech industry. You know, inflation on wage was, I mean, since the last 3 years, it was very important. During COVID time, it really accelerated, and 21 was worse year for us. I mean, for many reasons, there is no visa in a rich world anymore, so you were used to import, tech workers in rich countries. A lot of people wanted to change the job. A lot of investment too. So when you are investing, you are hiring. So a lot of pressure on the tech world. So I think that if inflation on wage in the tech sector reached a peak in 21, and in 22 it's cooling down a little bit. That's what we see. Maybe less investment. Clearly less investment. And I think if you're working in the tech sector, you are not impacted by the energy price. So basically the salary is just a link to the availability of the resource and the people you want to hire. And what's happening today is, in the tech industry, we'll not be able to raise our price since the last 10 years because of competition. And today we have some opportunity to raise some price sometime because we have some indexed contracts. So actually, I think the situation is better in terms of inflation. And better, especially if you're hiring people. It's a nice opportunity to hire people and pay them well, to hire good talent and pay them well today. So I'm not negative at all about inflation.
Thank you, Pierre. Maybe I'd like to start on one thing in the private sector, which is valuations, because there have been some words, some speeches that we've heard recently about valuations in the private sector. Here's the question: have valuation in the private sector gone too high? Pierre-Henri?
Yes, probably for some of them, but for me it is history now. No, we need to be focused on liquidity, because every financial system needs liquidity. Without liquidity, it doesn't work. And on this one, obviously, as of today, the IPO markets are closed, but we believe that it will obviously reopen at some point, probably 2023. And here, we will have a fantastic opportunity for the European Union, and especially France, to do tech IPOs again in Euronext. And it is, I think, very important, both for sovereignty reasons, obviously, but also to capture investment, foreign investment in Europe, because they will understand that we are able to provide liquidity as well. So we have started with the IPO of Believe Digital, of Aramis, of OVH, and I think we have the opportunity maybe in 1 year to generate another wave of IPO, which I think is very important.
Virginie?
I mean, trying to take another angle or to complement. Yeah, I mean, there's been in 2021 a very hot market for some sectors, and there is still a hot market for some sectors. We can come to it later, because I know you want to take us to climate and sustainability, so we'll leave that on the side. For the tech, the digital sector, the market correction started back in November, as we all know. I still believe that the way I look at it as an investor is about where do you stand as a company? Are you a category leader? Are you champion in the disruption that you're bringing to the market? How fast can you scale? Can you penetrate the US market? Because you like it or not, this is the big game changer for many of our companies, having hopefully successfully developed France, Germany, and a few other European countries, but Germany is the big game changer. And then, it may sound weird, but even if you have a little bit overpaid, which might sound as a British understatement, in Q3 and Q4 of last year, if you've made the right bets and you are backing the right companies, and those companies, be reassured, a number that of the next CAC, the next 40 index, they're still growing north of 50-60% this year. So you're digesting your multiple of revenues, ARR, whatever you call it, whatever you're looking at, in 6 or 9 months. if you have made the right bet and you are, backing the right companies. So I look at growth, I look at leadership, I look at market share, I look at scalability. And I think from a European standpoint, it's not a bad thing that the market has corrected. I do not know whether we still have to digest another reset. Some investors think it might be another 20 or 25%, something we have reached now. There's a stabilization for tech and digital. I do not know, but I do know that European companies have always been cheaper than US. It's always been the case. And it's probably a very good entry point for investors to continue to invest behind new technologies, new disruptive model in Europe. Because the competence is here, the CEOs are brilliant, the academic level and performance and training is compared to none, and the valuation are extremely attractive.
Thank you, Virginie. Bruno?
Yes, I think in some cases you can accept a rather high valuation if you have a strong belief in the equity story of the assets and the promise of growth of the top line of the company. I think the main impact that is coming with the increase of interest rates is that we are going to focus a little bit more on profitability than before. Because €1 in 5 years is nearly the same as €1 today when you have no interest rates. And everybody knows in this room that it's quite different when you have high interest rates. So it's, in French, we would say, c'est le grand retour de la finance actuarielle. Discount rates are important. So 100 euro profit in 5 years is not the same as 100 euro profit today. Sorry for the basics, stating the obvious, but I think this is the main change that we are going to live through.
Thank you, Bruno. Pierre, maybe a word on valuation?
I'm not very much on the investor side. Talking about profitability, I will talk more about efficiency of the model. Some company cannot be profitable in very short term, but we have to look at the efficiency, how much you spend to sell, on this kind of thing. And that's true, that's what we have been happening in the last 2 years. We're hiding something, some company were not operating very efficiently. But I think, yes, I think the tech is very scalable, it can be very profitable. So I see no reason why we find investors in the future.
So just getting back to the IPO market, there is a question rising in the market, which is how can GPs can they get a proper exit in the current IPO market? Maybe Virginie, you want to comment on this?
GPs in the sense of
general partners,
private equity, general partners.
Yes.
Well, I mean, you've seen it. There's been a massive wave of IPO in Europe. I mean, 5 years ago, there wasn't that many players in Europe. Only US GPs were publicly quoted. Now, fast forward, you have many, great companies of different size in the Nordic, in Switzerland, in France. So the market certainly has opened up. I guess, owners of GPs have been tempted for different reasons: succession, liquidity, primary money to seed their own growth. Many reasons can justify to be tempted by the public adventure. So now I would say there's, a handful of publicly quoted GPs. Of course, since the beginning of the year and the market correction for a number of GPs has been as tough as the market correction for some of the tech companies. I mean, we're talking minus 50% for some of them since year to date. On average, I think the alternative asset management, US plus Europe, has corrected by 33-34% since the beginning of the year. And you could say it's a very similar mechanic than the one which led to the market correction of digital. Not that asset management doesn't produce profit, it actually do very significantly. GPs are very profitable, but it's about the actualization to, the present value. Sorry, actualization is sort of a French English It's about the present value of the future, management fees and FRE being actualized to today, which of course I think the market doesn't bet on as much growth, as much size, as much deployment for the asset management. But some companies in our sector were valued 35 times 2023 FRE, and sometimes 50 times. So it was very much the mechanic that we saw in tech. So less IPOs. A number are still, thinking. Probably they will come back to the market by, I guess, Q2 2023.
Okay. Pierre-Henri, Bruno, maybe you want to add a word?
In our exit process in the Western world, we don't rely that much on IPOs. There are many other ways to get liquidity, as you know. In China and Southeast Asia, the IPO market is still very booming. They introduced new regulations in China to make listing companies easier. They created a new market, which is now very famous in Shanghai, which is more or less the Chinese Nasdaq. Some of our portfolio companies have been successfully IPO'd in this market, and I think there are still more than 400 Chinese companies waiting to be listed in Shenzhen, in Shanghai, or in Hong Kong. Of course, listing in the US is not a good idea. It's not a good idea. And since the very beginning, I think if you do business in a country, if you're regulated in a country, and then you get listed in another country where the relationships between two countries are a bit tricky, I don't think it's a good idea.
But still, do you see some Chinese companies wanting to list in the US?
Less and less, honestly, because it can be very tricky. We have some examples. And Hong Kong and Shenzhen and Shanghai are very, very dynamic in terms of listing. As I said, they revamped the regulation to make it much more business-oriented and to make it easier to get listed, and it's very successful.
Thank you, Bruno. Pierre-Henri, maybe a word on GPs and the exits?
No, I mean, to come back to what said Virginie, I think we believe that the market will be reopened by Q2 2023, but we don't know actually, because everything could change in a very short term. However, this is the kind of timetable we are working on. For tech IPOs, we know some of them which are preparing their IPOs for this window in 2023. And again, as Bruno said, welcome back DCF, discounted cash flow model, because obviously it will help also investors to find the appropriate investment vehicle, and maybe they will have more trust investing in companies at the occasion of the IPO. Yeah.
Thank you, Pierre-Henri. Maybe let's talk about sustainability. We touched on sustainability a bit earlier, but what I'd like to know is how much sustainability will count as a driver of private companies' future growth? Maybe Pierre on this. What's your experience of sustainability at Planisware?
Again, I'm not in the position of investor, but yes, clearly it's a mandatory path, and we have to go through this path. Frequently in the tech sector, companies are more in the solution space than the problem space, because a lot of companies are helping more customers to make cleaner products. But in the tech sector, most of the energy consumption comes from the servers and the cloud infrastructure. And as Catherine McGregor said this morning, I mean, it's good to have very measurable objectives, and actually which is a win-win situation, because if you consume less energy, your software is operating better, it's faster, and it's better. So we are more in that, and I think that clearly it's a mandatory path to if you want to make an IPO, but our customer is asking that from us, and I think we are entering. Actually, in the tech sector, it's a simple problem for us. So it's not like an energy producer like NG or this kind of thing.
But when they come to you, are they really concerned about what could be their future valuation if they are not sustainable at all?
You have to work on the subject and to propose something, a plan which is measurable, incremental, and 2 years ago I was say, okay, I was thinking, I have server, let's offset our carbon energy consumption. If you have server in France, it's quite easy. You have a lot of nuclear power plants, so it's working well. Now, if you have server in the US, it's a different story. And discovered that offsetting is not working. It's greenwashing, basically. And we have to reduce our energy consumption gradually. And there is some work, but I say it's a positive work. And we make better products.
Thank you, Pierre. Bruno, maybe on
I
sustainability?
think we have to be very clear. If you're in the private equity industry, you will not be able to raise funds if you're not serious about impact and ESG. It's as simple as that. So how can you be serious and a very serious player in this kind of topic? I think there are two ways. First of all, having a part of the portfolio dedicated to ecological transition and enablers, some assets, some companies that facilitate, I call them enablers of this ecological transition. For example, we invest a lot in new mobility, in energy transition. This is a way to be very active. But obviously, unless if you want to be regarded as a fund with the 9 number in the European taxonomy, you cannot invest 100% of your fund in this. For the rest, you have to be very careful where you invest, and you have line by line to design a roadmap with KPIs, not just de la flûte, line by line, roadmap, KPI, to push the company you invested in to improve, if possible, in this field. So it takes a very dedicated action with an impact officer, as we have organized in Cathay, to be sure you're doing the right things.
Just getting back to China, how does it play, that sustainable part in Chinese companies? Do they evolve in the right way?
It may surprise you, but they take at least environment and more social governance still to be improved, maybe sometimes, but environment, they take it very seriously. We should remember that the COP21 was a success also because we succeeded to bring China in. So the Chinese government is really pushing in favor of a better environment. Why they do it? Not to please us, because public opinion is requesting it. And I used to live in Beijing 10 years ago. In the morning at 7 a.m., you just couldn't see the sky. Now it's much better, and not only when there is a Communist Party, a big event, okay? Because they used to do that before. But now it is getting a bit better. It's not perfect, but this is to say that environment is a key issue in China. It surprises us because they used to pollute a lot, they still do it. And they used to say, as it was mentioned in a previous panel, oh, you developed world, you have been polluting for years, now it's our turn, we want to develop ourselves. But they changed the speech and they changed the behavior drastically.
But is that kind of a different sustainability, compared to Europe and the US? Is that kind of a local sustainability standards rather than, the West standards?
No, I think they are trying to stick to global standards, in particular carbon neutrality, that they set up their own agenda, their own deadline. Maybe it's not too quick enough, but it's a huge country. It's not so easy to do. And so regarding environment, they are getting more and more serious. Regarding social, there's still room for improvement, as we could say, but they passed a couple of laws recently to improve the situation of people who work for the GAFA, local GAFA platforms and so on. But it will take a bit more time.
Thank you, Bruno. Pierre-Henri, maybe on sustainability.
Yes, I think that ESGs, if you want to have customers, if you want to have employees, if you want to have investors, ESG is not a nice to have. It is an absolute must-have. And I think we are just at the beginning of a very deep revolution, positive revolution. And maybe it will be one of the few examples where finance will be able to be regulated by itself, I would say.
But just in the tech firms that you see, that you're covering, do you see more hires, in terms of, people focusing on sustainability, this kind of thing?
Yes, clearly. Especially in companies which wants to raise funds or which are preparing IPOs. Because, for example, for IPOs, it is an absolute must-have again, if you want to find investors. So yes, clearly.
Okay. Virginie, maybe on sustainability. I think you've got a lot to say.
Yeah, like all my panelists. I think it's funny because I was thinking, listening to Bruno, that the divide as far as sustainability is concerned is not East and West. It's, China and Europe or Europe and China have been, very active, and Europe very champion, and the US for sure has been lagging behind. We all know that. It's different in terms of, D&I, but clearly climate wasn't completely, their priority. Things are changing, although I'm always concerned that with, where the price of the barrel is now, like back to, let's say, $100, it's quite tempting when you're investing in the US that you go back to the good oil and gas investment. But anyway, on the side. So how do we think about it? We try, and we started many decades ago. It wasn't even called ESG, but we brought to the table, I guess, some of my conviction, which were about gender, where I thought our organization, Eurazeo, should be more gender balanced so that we would take better decision on which sector, which companies. And I had a partner at the time who was very much, pro-climate. And that was really early on, like 2006 and 2007. So we sort of started paying attention, shall I say, to diversity and carbon impact. We were not talking about neutrality back then. Then, we hired a complete team of people. I mean, I would have been amazed myself if someone had told me 5 years ago that I would have in the staff of Eurazeo some climate engineers, some forest specialists, some SBTI, trajectory specialists. This is what we have now, and this is what we need, because we're investing in mid-market companies. They need the expertise, they need the knowledge. It's extremely technical. I think we can talk about it better, we as a group of leaders, but it's really our team who have the best knowledge, because it's became so difficult and expert level that we need to bring that to our portfolio companies, our investments, so that they can put themselves under the right trajectory as far as SBTI and our commitment according to the Paris Accord, so the 1.5 degree by 2025 will be achieved. So that's more on the climate. It's interesting to see that a number of international investors are quite reassured by the trends that the world is taking, at least in Europe, and they're thinking that we're tackling, that issue correctly. I think this is a little bit too optimistic. I think we have to accelerate, and it's not just about investing in what we call at Eurazeo the 4 solution companies that Bruno was referring to, which is important. We have about 5 billion of our investment behind 4 solution company. Could be circular economy, could be healthcare, could be new protein, plant-based, things like this, vertical farming. But we're also putting like 60 or 70% of our investments, so massive, behind the 4 transition. And of course, there are exclusions, because I'm not going to invest in oil and gas. I'm not born oil and gas, so I'm not going in the direction. So, of course, we have a lot of exclusion. But I don't think we'll ever reach the net zero by just excluding sectors. We have to reach net zero by investing behind 4 solutions, which, by the way, is very much inflationary, because those investments in the 4 solutions are not cheap. And those models are certainly driving inflation in many ways. But we also have to invest significantly behind the 4 transition, meaning it's okay to invest behind, industrial plants producing, I don't know, CDMOs or pharma, but you have to take a commitment that you're going to change the supply mix of those companies so that there's a before and after. And I think that's where you are going to make most of your impact behind for transition.
Maybe one question on what Bruno was touching on earlier about regulation, about taxonomy, SFDR, CSRD. How does it play in Eurazeo's portfolios? I mean, how do you adapt to this? Is it helping you to go through the transition?
I'm not sure it's helping. It's an enormous complexification. However, I mean, we're lucky enough that we embarked on that transformation like 15 years ago. So 85%, I think, of our funds are either Article 9 or Article 8. Of course, a vast majority would be Article 8. And as I said, about 5 billion of our investment are Article 9. However, I think it actually helps more our investors so that they know that according to the new European taxonomy, we are qualified or we have a proper reference. I think my concern in terms of Article 9, and I'm not pushing too much that too many of my funds would be referenced as Article 9, is that we're missing a big leg of the European taxonomy in terms of Article 9, which is the social taxonomy. And we'll know more probably by Q1 or Q2 next year. So I want to make sure that I can, comply with my commitments. So the one that I have referenced as Article 9, I know they're not going to be impacted negatively, and then we'll take more decision in terms of referencing of those funds by next year.
Thank you, Virginie.
If I may add something.
Sure.
I think on top of taxonomy, one important KPI to check if an investment firm is very serious or not about impact. Just how much time do you spend in investment committees to talk about impact of a case? How much time? Just a few slides written by junior teams and then, okay, standardized? Or do you really spend time in IC? And one more question. Does it happen sometimes that on a very sexy investment case with nice return, you will drop the case because it's not totally, what it should be in terms of impact? Has it happened to your fund? Are you ready to do that? I think it's an interesting question.
And maybe just one last thing, so we can then, open up our thinking and maybe decision-making in the months and years to come. Carbon, let's say, or let's hope that collectively we are going to deal with it, and we are certainly going in the right direction. There's many other planet boundaries that we have to care about. Water, biodiversity, ocean, and it's just so early days that no one has done as much as it's needed, and it's another layer of complexity, because that again is about expertise, measurement, and ability to find the right investment in order to be a real contributor to that ambition.
Thank you. Maybe I'd like to know if there is any questions in the room for our panelists today. I think there are some microphones in the room for any questions if needed. And please raise your hand. There is a... Sorry. One is coming.
Thank you. My name is Malena Kamp from Morocco, from Casablanca. So my question goes for Eurazeo. I mean, as an asset manager, you are in that kind of middle position. On one hand, you would like to bring some positive impact to the planet. And on the other hand, you're talking about this return, the value, the present value is here. And it's, when I say it's the call of the investor at the end of the day. So how would you make it?
I am a great believer that you can do good and make money out of it. So, and we have ample examples that it's not a fight between the two objectives. Absolutely not. I don't know where that comes from. It's been decades of thinking that you either make money and you turn your back to any extra financial, any sustainable investment, any D&I progress. But that's completely, I mean, not wrong, because I don't want to sound aggressive or negative, but it can happen. It has happened. There's been trillions invested in the world going in the right direction and making money for their investors. And this is happening as we speak. So I'm very positive that we can continue. Sometimes you have to reduce your return expectation, just like you do when you invest in infrastructure, which is an asset class which sort of yields a 10, a 12, a 13, a 14%, and then buyout is supposed to yield a 20, 22, 24, you name it. But you can absolutely, cohesively and coherently progress on both fronts without any, difficulties. I am a great believer of that position, absolutely.
I think we might run a bit out of time, for other questions, but please just ask our panelists at the exit of the session. I would like to thank all of my panelists today for being there and for sharing their insights. And I think there is also a lot of sessions, very interesting sessions coming in just after ours. Thank you.